Ever wondered about the different types of dividends companies offer their shareholders? Well, dividends are an interesting aspect of the investment world. In essence, they are a share of a company's earnings, distributed back to its shareholders. These payouts can be an appealing feature for investors as they provide a regular income stream while also offering the potential for further growth. When a company is profitable, it has a decision to make. It can reinvest those profits back into the business to fuel expansion, or it can distribute a portion of those profits back to its shareholders in the form of dividends. And guess what? Many companies choose to do both. Dividends can come in various shapes and sizes, each with its own unique set of advantages and considerations. Understanding these different types of dividends can empower you to make more informed investment decisions. So, let's dive into the various types of dividends that companies offer. First up, we have the most common type of dividend, cash dividends. Picture this: a company has had a profitable year and now wants to share the spoils with its shareholders. How does it do that? Through cash dividends. These are a portion of the company's earnings that are distributed directly to the shareholders' accounts. It's like receiving a slice of the pie you've invested in. This could happen in a variety of ways. It could be a direct electronic transfer into your account, or you may receive a printed check or even cash. The beauty of cash dividends is in its simplicity. There's no need to sell anything or wait for the right market conditions. The company makes money and you as an investor get your share. No fuss, no hassle. Cash dividends provide a direct return on your investment. Next, let's explore stock dividends. A fascinating alternative to the more common cash dividends, stock dividends involve the issuing corporation paying out dividends in the form of additional shares. This method effectively increases your share in the company without requiring an immediate cash outlay. Here's an exciting facet of stock dividends. They are not immediately taxable. That's right. You only need to pay taxes when you decide to sell these extra shares. This delay in taxation can be a boon for investors, allowing the value of these shares to potentially grow over time, untaxed. Moreover, stock dividends also provide a degree of flexibility. They can be retained for long-term growth or sold for immediate cash, based on your financial strategy. It's like having an investment with a dual nature. Growth and liquidity, all rolled into one. Stock dividends can be a great way to grow your investment portfolio. They offer a unique blend of growth, flexibility, and favorable taxation, making them a compelling choice for savvy investors. Now let's talk about property and scrip dividends. Picture this. A company you've invested in decides to pay dividends, but instead of cash or additional shares, you receive a piece of real estate or some other tangible asset. Sounds intriguing, right? This is precisely what happens with property dividends. Property dividends, also known as dividends in kind, are payments made in the form of assets other than cash from the issuing corporation. The assets distributed can vary widely. They might be investment securities, physical assets, or even real estate. The value of a property dividend is based on the fair market value of the asset when declared. This kind of approach is less common but can be exciting, especially if the company has a valuable asset to distribute. On the other hand, we have scrip dividends. Imagine a scenario where the company is a bit tight on cash but still wants to reward its shareholders. It can issue a promissory note, promising to pay dividends at a later date. This is what we call a scrip dividend. Scrip dividends are essentially IOUs from the company. They are a promise to pay shareholders a dividend at a future date when the company is in a better financial position. The neat thing about scrip dividends is that they often come with the option to convert the owed amount into shares of the company. This option can be attractive to investors who believe in the company's future growth prospects. Both property and scrip dividends present unique opportunities for investors. Property dividends can provide unexpected value, especially when the distributed asset appreciates over time. Scrip dividends, while delaying immediate financial gain, can provide an opportunity for increased ownership in the company, potentially leading to larger returns down the road. However, these dividends also present challenges. Property dividends can complicate an investor's tax situation, and scrip dividends carry the risk of a company not fulfilling its promise to pay in the future. But with risk comes reward, and these types of dividends can be a valuable part of an investor's portfolio. These types of dividends offer unique opportunities and challenges. Scene script. Up next, we have liquidating special and interim dividends. Let's start with liquidating dividends. These are the payments issued during a partial or complete liquidation process. Think of it as a farewell gift from a company that's about to close its doors. When a company decides to wind up its affairs and dissolve, it usually sells off its assets and pays its debts. If there's anything left, this surplus is distributed to the shareholders as liquidating dividends. It's important to remember that these dividends are derived from the company's capital base, not from its earnings. Now, moving on to special dividends. As the name suggests, they are special because they are not regular payouts. They are one-time dividends that a company decides to distribute, often following a strong operational quarter with excess cash. Say a company had a particularly profitable year or sold off a subsidiary or an asset, it might decide to distribute a portion of that windfall to its shareholders in the form of special dividends. It's like the cherry on top of the regular dividends that the company might be paying. Lastly, let's talk about interim dividends. These are dividends that are declared and distributed before a company's annual general meeting and the finalization of its full-year financial results. This practice is common in countries like the UK, where companies often make semi-annual payments. It's like getting a sneak peek into the company's performance for the year. But remember, these are just interim dividends, and the final dividends might be more or less depending on the company's full-year results. So there you have it. Liquidating dividends that come into play during a company's liquidation, special dividends that are one-off payouts following a good run, and interim dividends that are like a preview to the final dividends. Each one of these dividends can offer unique opportunities for investors. Lastly, let's look at some other types of dividends. It's not always about cash or shares. Sometimes companies get creative and offer unique financial assets as dividends. This can include warrants, which give shareholders the right to purchase additional shares at a fixed price. Or maybe shares in a brand new spin-out company, an exciting opportunity to get in on the ground floor of a fresh venture. Then there are options, which grant the right, but not the obligation, to buy or sell a security at a set price within a specific time period. They can be a powerful tool for investors looking for flexibility. And let's not forget other more exotic types of dividends that may be distributed under certain circumstances like convertible bonds or even cryptocurrencies. These rare types of dividends can offer unique investment opportunities. They may not be as common, but they certainly add an interesting twist to the world of investing. Understanding the diverse landscape of dividends empowers investors to make informed decisions. As we've seen, the world of dividends is not a one-size-fits-all scenario. Each type of dividend carries its unique characteristics and potential advantages. Cash dividends, the most common form, offer a tangible return on your investment, directly deposited into your account. Stock dividends present an opportunity for growth, as you acquire additional shares in the issuing corporation, tax-free until sold. Moving on, we explored property dividends, an interesting alternative where payments are made in the form of assets, whether that be investment securities, physical assets, or even real estate. We also delved into the world of Scrip Dividends, a promissory note issued instead of immediate cash dividends, offering shareholders flexibility in their payout timeline. In the event of a company's liquidation, we learned about liquidating dividends. These are derived from the company's capital base and usually precede the closure of a business. Special dividends, on the other hand, are one-time payments that a company can decide to make following a strong operational quarter with excess cash, while interim dividends are payments made before a company's annual general meeting and the release of full-year financial results. Lastly, we touched upon the rare instances where companies may distribute different financial assets as dividends, such as warrants, shares in a new spin-out company, options, and more. When deciding which types of dividends are most appealing, it's essential to consider your personal investment goals and risk tolerance. Are you looking for steady, predictable income, or are you more interested in potential growth? Do you prefer the certainty of cash or the flexibility of stock dividends? Each investor's situation is unique, and what works for one may not work for another. Our journey through the various types of dividends is designed to provide you with the knowledge to answer these questions confidently. The more informed you are, the better your decisions will be. Stay ahead of the financial curve and make wise investment choices. Invest wisely.